But let's talk a little bit more about you mentioned raising private capital. I know that's the one thing that one of the things that really sends people through a loop. I know we've had prior conversations. You raised your initial capital through family and friends, but now that you've gotten to a bigger stage, you're doing larger projects. How are you presenting these deals, and what benefits are you offering private investors right now?
Yeah, I mean, from the day, realistically, from the day we started to today, our knowledge base has evolved. We're miles ahead of where we started on day one when we were starting to do, when we started with really a 3-family, but we sprinkled in some single family stuff, but we don't generally do a lot of single family in the city anymore. But I'd say, for this particular project, I mean, what we offer. What we try to do is put together a scenario for our private investors, and we started with friends and family. A lot of the people out in Boston Wealth Builder Nation, maybe just starting to do their first projects. I mean, that's how you start, or you go out and you network with people who are looking to, invest into alternative assets. So education is part of that. You really have to educate your investors if they don't know it. All right, so your friends and family will always trust you and think, hey, I want to support you. But once you start getting outside those circles, you need to be able to educate people and get them interested in what you're doing. So what we generally do when when I meet somebody new or a new investor, I'll just tell them exactly what we do, and we're real estate operators. We're developers. We do some cash flow buildings, some larger kind of multifamily asset stuff, but. And we do that because there's a little bit of a diversification regarding the actual asset itself. So on our development plays, I mean, development inherently is a little bit more risky than buying, let's say, a stabilized kind of cash flow building where people are already renting and there's already an income stream coming out of the building. Where development, you're buying a piece of dirt, if you will, or an existing house you're going to take down or renovate completely. During the construction phase and permitting phase, there's no capital coming in whatsoever, and it's just a big kind of hit at the end of the project. So there's inherently a little bit more risk. Any type of investing, no matter if it's stock market, alternative assets, or anything, is all about risk tolerance. And is the return you're providing commensurate with the risk that the strategy entails? So for development, it's a little bit higher of a risk, so we generally give a little bit higher of a return. We'll generally have, to protect our investors with some downside risk, is we generally give a preferred rate of return. Gotcha. So no matter, instead of having straight equity partnerships when we raise capital into the single purpose LLC that you buy the building with, we'll say we give like an 8% preferred rate of return.
Guarantees they put something in their pocket.
Exactly. So as the project's going, if the project goes a little bit longer, well, they're still making their 8%, right? So and then, and you calculate that once the building is sold and you figure out how many days did I have your money for, and here's your 8% based off of that. Because at the end of the day, everybody's return is one of the important key components to focus on is your time value of money. The longer you have somebody's money and you're giving a flat return, that return diminishes. So you want to keep constant with that. So providing a preferred rate of return to your investors prevents their downside risk and doesn't expose them to just a larger equity position where if the project doesn't do as well as you say, they're not getting completely demolished, but they're not achieving as high of a return. This just protects them for something like that.
Gotcha.
So on the other side of it, sorry, I got a little long-winded there. On the other side of it is the equity piece. So we tie them to a piece of equity as well that also boosts their performance if our performer, which generally comes in higher, which we're always trying to have a better, obviously, exit price than our or exit returns than our performer does. So you tie them with a preferred rate of return and a piece of equity, and we combine that in order to provide the returns that we give to our investors.